What time will the market run algorithmically? For the note-taking folks, the ones that are really taking it serious, learning, macros in price action, okay? Unless we're talking about the last hour between 3 o'clock and 4 o'clock in the US markets, okay? The last hour, 3 p.m. Eastern Standard Time to 4 p.m. Eastern Standard Time. There are 4 specific macros in that 1 hour time frame. Every single macro apart from that one is only 10 minutes till the top of the hour to 10 minutes after the hour. There's a macro in every single hour. Okay? A macro only exists 10 minutes before the top of the hour. That means, in this case, what time is this? What time is that right there? It's 7:51. Okay? That's 9 minutes before the hour of 8 o'clock in the morning. So if we take a rectangle here and you go to 7:50 to 8:10, that is the macro. See that? What did the market do? We're bullish. Where's the buy side? Here, because it stopped right where it did over here on the 15-minute time frame too. That's this candlestick right here. That candlestick's high on the 15-minute time frame is that individual 1-minute candle right there. See that? So what does it do? It drops down at 7:51. What is it doing? It's dropping down to take the liquidity out here on that low. To do what? To start spooling. Where? To clear the liquidity above here. Not a replication or renaming of anything that's ever existed before. So when we see this, inside and center, right? And what you want to do is when you're tape reading, you want to spend the majority of your time focusing on what price is doing 10 minutes before the top of the hour to 10 minutes after, okay? What happens is the price engine that is the algorithm many times will spool, okay, during these times, and it will run to where the stops are, or it will run to where the inefficiencies are. And what do I mean by that? Inefficiencies are gaps, whether they're up close gaps or down close gaps. One singular candle moving in one direction, that's an inefficiency. And that's what we've been talking about and showing here. So this is the algorithmic price run. This is just the run-of-the-mill scalp. Which one would you rather be a part of? If you're trying to buy on a day like this and it's bullish and you're aiming for the levels I was outlining here when we first started our live stream, which one would you rather be a participant in? Some random price only entry versus a very specific algorithmic advantage where price will absolutely start spooling and reaching for the liquidity based on time first. What the structure at the time is I'm trading in. Sometimes I'll do that. But when it does this here, then we can go back into, okay, what are we looking for if we miss this move? And we'll go right into tape reading the opening range. We have a low, high, lower low. That makes this up close candle a breaker. It look like. And the market trades down here. And also, what is it doing here as it trades down into that bullish breaker there? This is not support and resistance, because support and resistance would have been, okay, well, it went above here, so it should stop there and go higher. That's how I lost money in the 90s, because support and resistance is going to be the, the be-all end-all, and it wasn't. I lost a lot of money trying to do that stuff. And it's the entire range of the up-close candle. The highest up-close candle is your breaker. In this case, it's not even trading down to the low, but what is it doing in addition to that? You see this? That right there is a nesting of 2 PD arrays. So this is an old buy side unbalance, sell side inefficiency, fair value gap that was used right here, and then it went up. But did it rally above that high here since this movement here? No, it didn't. It's consolidating. So it drops back down to it here, and you're still inside that breaker. So you have to afford, if you're trading long, your stop can't be so trailed up to get stopped out prematurely. So that's all factors of how I would measure where I would move my stop. So if I was going long down in here, if I went in and bought this immediate rebalance, which is the open trading down, immediately going back to this candle's high, that is extremely strong. Immediate rebalances. They are the bee's knees for entries. If you can get in, or if you're supporting your trade with a stop loss below a immediate rebalance, and your targets or liquidity hasn't been traded to, the market is absolutely not going to your stop loss. And you heard exactly what I just said. That's not me exaggerating. These types of trades happen all day long. These trades only happen at certain times of the day, but they repeat certain times of the day.